So hi guys, welcome and welcome back to my channel. If you're new here, karibu sana. If you're a returning subscriber, welcome. So today I want us to start from where we stopped last time. And basically, we had already started tackling the kinds of investments that you should take depending on where you are in life, right? So last time we talked about those people who have low risk tolerance, but they either have low capital or those who have high risk tolerance and low capital, and we discussed the kinds of investments that they can take. So today I want us to tackle the second half of this quadrant. This is basically people who have low risk tolerance but have high capital, or they have high capital and high risk tolerance. Okay? So let's just jump right into it. And for today, we are going to begin with people who have high capital and high risk tolerance. So for this category of people, the one investment that they can partake in is what we call special funds. Okay. If you remember last time, we talked about equity funds, we talked about balanced funds. So today, I want us to talk about special funds. So, what are special funds? A special fund is a fund that can be set up either by a government or a corporation, just to collect and use money for a specific purpose. For example, if a government sets up a special fund, it could be for youth. For example, they want to invest in the youth, or it could be for women. But in our case, since we are not the government, we're going to talk about corporations. So you're going to find different companies who will offer you a product, which they'll call a special fund, whereby they'll collect money from you as an investor. This money is going to be invested, in different categories. It could be, fixed income, it could be derivatives, but they also promise to give you a return. So the features of a special funds are: one, these, first of all, are not for everyone because they have a high minimum investment that ranges between 250K to 500K, just as a bare minimum. So, again, this is not for everyone. That's why we say this is for people who have high capital and also have high risk tolerance, okay? For these kinds of investments, they are targeted, Remember, for money markets, we said for money markets, they are invested mostly in treasury bills, okay? For balanced funds, they will balance between equity and other kinds of fixed income. For equity funds, they'll just invest in equity or shares in different companies. But for when you talk about special funds, they are more targeted, they could, some even invest in forex, some invest in derivatives, but all this is just to make sure that you have a higher return. So for these ones, they aim to give a maximum return. For example, there is one that's called Kuza, where last year they gave the investors, I think, 45% returns. You see, that's a really high return. The kind of downside of this one is that it's not very liquid because they have lock-in periods. You'll, for example, be asked to lock in your money for a month, a year, a quarter. So this is not money that you can easily access because, again, for you to get higher returns, you need to lock in your money for a particular period of time. Okay. And then again, for these ones, the risk levels are moderate to high because, unlike the money markets, there is no capital guarantee. You might lose it. But like we say, the higher the risk, the higher the return. So if you're someone who has high capital, you're not afraid of risks because you see, if you win, if you get 50% of your original investment, that is a really good, return on the amount that you had invested in. So it's something that I'd encourage someone to go into if, again, you're not afraid of losing. So that it does not sound theoretical, I'm going to give us examples of special funds in Kenya. I think the most popular one is the Mansa X by Standard Investment Bank. So for this one, it's a multi-asset. That is to mean that your money is not going to be invested in just one class of assets, okay? And then you see for this one, the minimum investment is 250K, okay? And well, why you're asked to invest the 250K is because they are going to guarantee you a high return of between 30 and 40%. So you see, again, this one is not for everyone. And as a disclaimer, the information I give here is just for you to know. But if you want to invest, then I'd encourage you to do your research, before you actually settle on the kind of special fund that you want to get into. Okay. The other one that's quite popular is the Oak Special Fund. This is by Faida Investment Bank. This one was launched in the Q1 of 2024, and the minimum investment is 500K. For you to actually invest in this special fund, you'll need a minimum of 500K. Again, they promise you high returns. They're not very liquid, but since given these people already have like 1 billion in terms of investments, gives you some sort of, should I say, surety that your money is not going to get lost? Yes. And the one that had caused shockwaves in the market is the Kuza Momentum Fund. So this one, for you to get into this, you have to invest a minimum of 250K. Again, we say there is a lock-in period. You cannot just get your money as and when you need it. But again, like I said, last year they paid people a return of 45%. So I'd encourage us, before you get into this, just go do your research. Of course, at a later date, if you would like, I can show you how to get into this, practical step by step. But for now, it's just to give you knowledge. If you have money, you don't know where to invest it, these are some of the funds that you can get into that are promising you high returns. Of course, for a high risk, because uh, your capital is not guaranteed, but when it works for you, then it works great. Because assuming you had invested 250, if you get half of that is 125K, I don't think there's any investment in Kenya that's going to give you such a high return, for such a short period of time. So yeah, this is for people who have high risk appetite and also have high capital. These are the three companies that I know of that you can invest in special funds. All right. Then we have the second category of people. Those are people who have high capital but are low risk tolerant. So for this category of people, what we can advise them to get into is what we call government bonds. I remember last time we said the ways in which a country, or rather the government of a country, raises money is one, through taxation, and two, through lending. And we said lending or borrowing can be either internal or external. We said for external is where they borrow from people or institutions such as the World Bank. Internally, we said they can either borrow short term, which is through treasury bills, or long term, which is through government bonds. So technically, a government bond is a debt security that is issued by the government, just for it to raise funds. And what I've seen by bonds, they're specific. They can either raise bonds for infrastructure, mostly for infrastructure or for any other thing that they need to invest in. So how do bonds work? For you, you need to lend the government money. So what happens is that the government is going to issue a bond prospectus, right? Which is technically like asking for you to invest money in the government. Lately, the rates for the government or T bills or anything that has to do with borrowing from the government, the rates have gone really low. But let's assume, for example, you take up a bond where the interest is 12.8% annually, again, based on the bond value. That just tells you, for example, if you invest 100K today in a government bond and the rate is 12.8%, it means that at the end of the year, you should get 12,800 as interest. Because remember, interest is paid regularly, but the coupon, which is the original value that you invested, is going to be paid out as at the end of that bond. Okay. And then bonds have different maturity periods. Some go for 10 years, others for 20 years, others for 30 years. And then so the pricing will fluctuate depending on whether you invest in the secondary market or in the primary market. Let me explain. When you talk about primary market, when the government, for example, issues a bond prospectus, like right now, they've already reopened some bonds. If you invest directly through the CBK, that is what we call the primary market. So in that case, if they say that the minimum investment is 50K, then that means you're just going to pay 50K. But let's assume the bond period closes and now you now have money and you want to invest. You can still invest, but now through the secondary market. Secondary market is where you now buy like from this stock exchange, okay? In this case, it tends to be higher priced because remember you're buying from a secondary party, not the original party. Again, this is a whole topic that we can talk about in a different video, but just to introduce to you, government bonds are something that if you have money but you have low risk tolerance, then this is something that I'd encourage you to get into because, first of all, your capital is guaranteed. Because, like I said, ever since we got independence, the government has never defaulted on any of its debts. So, not unless it starts now, you're pretty assured that you're going to get back your original investment. Okay. Um, the other reason government bonds are not for everyone, the minimum investment ranges between 100K and 50K. So again, if you're still not here yet, remember money market is a good place to start because it will help you grow your money. And then now when you grow it, you can move into other forms of investment such as the government bonds. Okay. So, like we said, the risk is really low because you're almost assured, but also the return is really low because you see, unlike the special funds which are giving you 45%, then a government bond is going to give you 12.8% annually. So I do not want to assume all of us have seen what a government bond looks like. So let me show us what a government bond looks like. So this is the bonds that have been reopened by the government that are due in May. So if you have some amount of money laying around, you might actually consider to get into these bonds. So the first one, for example, is this FXD 2012. This is an infrastructure bond, and the years to maturity is 7.6 years. So that means if you invest in this bond right now, it's going to mature in 7.6 years. You see the coupon rate is 12%. The coupon technically is the interest rate, right? But remember, these ones are taxed. These ones are not tax free. Well, not all bonds are taxed, but for these particular ones, they are actually taxed, and the tax is 10%. So that means after tax, the return is going to be around 10.8%, if I'm not wrong. Yeah. You see, these bonds are going to mature in 2032. So if you get into it today, like by May, because this opens and closes in May, this bond is going to mature in 2032. Okay. Again, see, the minimum investment is 50K. The maximum investment is 50, is it million or billion? 50 billion, depending on how much money you have. Okay. So this is what we are talking about when we talk of bonds. All right. So when the prospectus has been opened, it means you can now start bidding. I can take us through the process, but again, at a later date, I just wanted to show us what bonds look like. So this has been issued by the CBK. This is one of the bonds. The other one is this FXD 2022. The years to maturity is 22.5 years. So that means if you take this bond this year, it's going to mature in 2047. Okay. The coupon rate is 14.1%. That means the interest rate that you get annually is 14%. Again, after tax, it will come to around 12%. Okay. Similarly, the minimum investment is 50K. So if you have some 50K lying around, this would be a good place to start. Okay. Finally, the other bond that has been opened is the FXD 2022 15. This one goes for 12 years. Okay, the coupon rate, or rather the interest rate, is 13.9%. Okay, similarly, so it just works the same way the others work. All right. So one thing I'd want us to know is that as much as bonds give us an annual interest rate, the interest is paid out semi-annually. Okay. So, for example, let me give us an example so that it's not theoretical. Assuming right now you want to invest in this 7.6 years bond, okay, and you invest 100,000, the coupon rate is 12%. Okay, so that means 100,000 times 12% times 1 year, that is 12,000 per annum. Okay, remember this is paid out twice. So that means every 6 months you're going to get 6,000. So, for example, since this bond opens in May, it means your interest, the first interest is going to be paid 6 months after May, that is in November, and the other interest, the other 6,000 will be paid in May of next year. Okay. So, in short, what we're trying to say is if you invest in a bond today, you find your initial investment, which is this 100,000, is going to be given back to you at the end of the 7.6 years. Okay. But the interest, which is 12,000, is going to be paid out twice a year. Okay, so that means after every 6 months. So if this bond is opened in May, right, that means the interest, you're going to be getting your interest every November and every May. Okay. And one thing I'd like to tell us, which is quite exciting, bonds are actually a very good way, if you're still renting, to be able to take care of your rent and not get worried about it. And how do we do this? We do something called bond layering. Uh, this table here tries to explain what bond layering is. When I talk of bond layering, I mean if you, for example, have 400K, instead of investing all of it in one bond, this one that matures in May or in November, you can actually split your money across different bonds, because again the CBK will announce bonds at different times and they also mature at different times. So for example, if you have 400K, you can decide to split it across four bonds, so you can take the first bond which matures or which pays interest between January and July. Okay, so assuming the interest rate is still 12% per annum, it means every January and July you get 6,000. Okay, You can take another bond that matures between March and September. So that means every March and September you have 6,000. Every May and November, like that. So you see, at the end of the year, you'll find out that every month you're getting an interest paid out, you see, and that is if you had invested 100K. Remember, you can still invest incrementally, like well, I think I closed that slide, but there's a point if you read that prospectus which tells us that the minimum investment is 50K, but you can also put in additional investments of 50K. So if you begin with 50K today or 100K, and then you continually invest, that means, for example, if you had 200K, you'd have 12,000 in January, 12,000 in July, 12,000 in March, 12,000 in. You see, if you put in all these 12,000s together, assuming you're living in a one bedroom rented house somewhere, which goes for like 15K, that means the only money you need to get out of pocket to pay for rent is like 3K. You see? So bond layering is a really, really good strategy that can help you to, stop thinking about the repetitive expenditure that you have to incur, for example, rent. Okay? So I hope you've learned a thing or two. If you have more questions, you can ask them down below. But I'd like us to end here for today. Um, we are going to have more sessions where we talk about bonds and I can take us through a step by step. But again, like we say in this channel, we don't just sit there, we do something. Don't be a lazy investor. Once I give you this information, take it upon yourself to go research. Then, if you have any questions, you can come to me. I already leave my contact in the description box, and then I can help us in any place that you're stuck. Okay, thank you for being a good audience, and until next time, bye.